This is Justin Pulitzer. This is my weekend review for Monday, May 30th, 2016. A lot to cover. A lot took place in the markets this week. We have a fairly interesting and potentially treacherous calendar next week. I'm going to dive right in and talk about what is going on with the market. So, I usually like to talk about my six market keys, 7 Fed keys. Lately, I've been commingling them, and I will likely do so again, just because lately the markets are the Fed. Sad as that is, it is unfortunately the truth. And then I get into the major market indices and then discuss some of the more momentum type stocks, the FANG type names, if you will. So let's do it. Anyway, the VIX, as I've talked about, is likely in a period like this of lower volatility with potential, brief spikes of panic. And you can see I drew in the mundane period we had, then the flash crash, and then a potential up channel that we were forming. We had a lower high, and we then broke the channel low. And you can see almost to the tick with a couple of little look aboves and fell. The channel low there had been quite severe resistance, and it has remained so. The bears here look like they were trying to get in some higher lows and some higher highs, but they have this week broken that trend here, you can see, and are really coming back down to kind of kiss the canvas here. The good and bad news of that. So the good news is that the thesis of being in a more lower volatility environment like we had here is looking like it's intact. The bad news is that you can sort of assume this like 13-ish to 11-ish area is a lower bound, and as we get closer and closer to there, that this area will reject. It's sort of a zero bound we probably won't get to. And if we do, it's likely not to breach. And when we did here, it was a major look below and fail, and we got, a flash crash. But the point I want to impart to you, ladies and gentlemen, is that I do believe that we are in a period here of a little bit lower volatility, and we could be looking to retest those lows. Once you kind of snap a trend line, you usually tend to retest where that came from. The low here was 12.5, so we are getting a little close there. All that means to me is that you probably want to be cautious. You don't want to be chasing. You definitely want to be more of a premium buyer than a seller. That can often be a chase. I have found in my experience that I'll often take on longer periods of duration just to cash in on premium. I don't always regret them, but I usually do. So like if I normally am looking at 30 days to expiration and I am pushing it to like 60 days or beyond that, there can be periods of correction. And then, like for example, if you're short puts, you not only have the price going against you, you then have the volatility going against you, and it can be a bit of a double whammy. Conversely, if you're long the puts or what have you, and you have price going with you, and you have volatility going with you, that usually is good. It's usually good to have your gammas and your vegas going in your favor. So just a little piece of advice there. Don't reach, to sell put premium and take on extra durational risk. Anyhow, that's what I wanted to say about the VIX. So let's go into the dollar. Help if I can type the right symbol. We are still in a bit of a downtrend, although it is starting to get challenged here a bit. I'll show you. I drew in, we had this big run up here the last year or so. Been in a sideways pattern, and I've talked about moves above and below not being sustainable. And here we are coming back into the range a little bit. All right, so let me just show you. I want to do this on a 9-month daily. So you can see we're starting to get into another volume distribution. We kind of eclipsed here. I drew in an unofficial regression line. We are now getting a bit above that. We're making some higher lows and higher highs, and we have broken this downtrend, and we are kind of just breaking into the regression line. So there's some good news and there is some bad news. I would assume the good news is that we are likely coming into some resistance, given that the dollar has moved a lot. There should be some resistance in this area, and I would think that that would give a little bit of pause to the dollar rally. The bad news is that assuming you're an equity bull, the more that... So I shouldn't say the bad news. I should say that this sort of becomes I forget what the term I used in the last video. I think I was talking about circular references for those of you that have used Excel. The dollar rallying, people will say, makes it more likely that the Fed is going to hike interest rates. But the more the dollar actually does rally, it may make it less likely that the Fed will raise rates. Now, what does that mean? It means that one of the things that Janet Yellen has discussed is dollar strength, and a weak dollar gives them a lot of cover to hike interest rates. But if the dollar is rallying ahead of that, their interest rate hikes would exacerbate this and likely bring the dollar back up to areas that they don't want it. So they kind of have to walk a fine line. This, of course, a weak dollar is great for companies that do business overseas and need to repatriate capital. So it's also good for companies like Caterpillar, for example, that does business overseas and faces very steep foreign competition, like from Japan and Komatsu, countries that devalue their currency, artificially make their goods cheaper to foreign buyers. The stronger the dollar gets, the harder it is for them to compete overseas. So that's my little spiel here about the dollar. I think we could maybe go a little bit higher, but we are getting into another volume distribution, and I think as we careen or rally into this area, it could be an area for a bit of a back off. So the 200 MA is obviously a very visual reference. That's up in the 25s. This would be a lot of strain, I think, coming from the dollar, but it's possible that we do get a move into the more mid of this range. So that's the dollar. The bonds are coming off a little bit. We had this double bottom here. They basically are sort of in a little bit of a downtrend, but kind of lower highs with equal lows, forming a bit of a bull flag, if you will. Here we kind of had a bit of a look above, failed, a bit of a secure high, coming back down, and it's a little bit below the 50 and the 20-day moving average, and I guess the 10. So my spiel here with the bonds is that the bonds don't necessarily need to be in super-duper rally mode. They just shouldn't be in a collapse mode. Let me show you what that would look like. Not a good one. Let me go back a little further. 2 years daily. Yeah, you don't want to see something like this. This, to me, means that interest rates are coming up quite a bit, and you have to be a little bit more cautious. I think that the market is in a little bit of indecision because of some of the mixed messages that have been coming from the data versus what some of the Fed heads have been talking about. I think this actually is a good juncture here to interject a little bit with the 7 Fed keys and why I really don't believe that the Fed should be raising interest rates. And the reason I feel that way is the jobs data. We had a non-farm payroll number that came out. It was a miss with revisions down. The Atlanta Fed has lowered their GDP reads. We've had very weak GDP. I believe we had a read on Friday, and I think it was Friday. The number basically, the prior period had been 0.5. The consensus for this one was 0.9, and it came in at 0.8. Same thing for the GDP price index was a slight miss. Durable goods is something else that, I kind of guess goes into this component that came in a little bit hot. I think the media got very excited about that it was a 3.4 versus a 0.3, which is a huge beat, but a lot of that beat came from aircraft and vehicles, and once you factor that out, it was only 0.4%. So that number has been very volatile, particularly in the commercial aircraft. That's when you hear about GDP reads, a lot of it is Boeing, and That has been sucking wind for a while. We know Boeing had cut their 747 production like in half, so I guess this is just some restocking that came into that number. The ISMs, I don't have the exact numbers in front of me, but I believe they weren't all that great. I know the PMI was a bit of a miss. It was a slight miss. Both the service and the manufacturing. I think we're getting another read of that this week. Let me pull that up here. I have the economic calendar. We have personal incomes, that's a big one. We have Case-Shiller, that's a big one for housing. Yeah, we have a Chicago PMI, and then we have the ISM manufacturing coming in on Wednesday. So this number here, the manufacturing ISM, is going to be important. The service one, by the way, was a miss, the last read. We'll get back to this this stuff here in a little bit. The big possible issue is, of course, coming in on Friday, which is the employment number. That's going to be very key. You're going to probably get a lot of movement on that and a lot of speculation on what the Fed may or may not do. Durable goods, I talked about already. I want to just touch on a couple of things with regard to that. Housing and autos are big components of that, and we know housing has been doing well, and we know autos have been doing fairly well, although they have been kind of coming down slightly. I've talked about potential peak autos. The key for that, though, is lower interest rates. Keep that in mind. If interest rates start coming up, that's going to hurt those numbers, and you'll have much weaker durable goods numbers. So a lot of the kind of strength that we've seen, any strength that we've seen, has been contingent upon these lower interest rates. Even consumer sentiment was a miss. I've talked about some of the things that the Fed looks at, particularly we know they look at the S&P. That has been doing well. I'll get to that in a bit. We know they look at the bonds, the HYG. This is giving them a little bit of cover. This gets the Fed kind of nervous because any recession or crash, usually as a result of a credit crisis, the fact that this is rallying is good. I think that this has been relieved a lot by the oil chart. I'm going to talk about that right now. You can see oil has come off these 26 lows and is back up into this resistance here of the 49 level. So that's almost a double in terms of oil, and I think that this was a big concern for the Fed because this is really what deflation looks like. And I would say that this rally back up has given the Fed, maybe a little bit of cover if they want to say things are getting a little bit better, because we, of course, have been using oil as the proxy for global growth. This was the backside of an old uptrend line, and I had talked about these 49s being some resistance. It's interesting, though, that this has not backed off much. You can see it had a bit of a look above and fail. It came back down here, held the 10-day like a champ, and has been basically riding it and just consolidating up at these highs. I believe longer term oil does want to see significantly higher. I've talked about potentially 75, but it wouldn't surprise me to see some type of a retest of the channel low first, particularly if you get a bit more of a hawkish Fed. With regard to the Fed and their hawkishness, I have taken some notes on some of the things Yellen has discussed, and for me, a lot of the issues that they've talked about are still very present. Yellen spoke on Friday. There was an initial read that everyone thought that her comments were very hawkish. I'll say this. She basically, for the most part, had confirmed what she had said in her last big speech. And then when pressed, still kind of said that interest rate hikes, they do see them as still being appropriate in the next few months. So the Fed, just keep in mind, has been wrong with all of their forecasts for the last 7 to 8 years. That's why interest rates are still basically hugging the zero line, and we have a stall speed economy. The Fed is just, they've been wrong. I mean, just flatly wrong on their growth. So some of the things she talked about, I'm going to tick these off and address what I think. Global risks, we know we have the Brexit coming up, and China and Asia has still been weakening, and there could be potential debt issues coming up in the summer with Europe, although I would say the Germans have taken a little bit of that risk off with regard to Greece, but that situation is always very volatile. Dollar and energy, we know that the dollar has come down quite a bit and energy has risen, so that has gone in their favor. She talked about GDP being just a touch lower than consensus. That has not changed. GDP has been rather weak. She wanted to verify that the labor market, any gains in the labor market had been sustainable. I just told you that the last reading for jobs numbers was a miss with revisions down. We have a big number on Friday. I know that traders, the Fed doesn't look at individual readings and make decisions off that. They look for a trend. So even if this number comes in hot, so to speak, the trend isn't really established because the prior one was a miss with revisions down, and we may have a pretty crummy read this time as well. So we'll see how that goes. Like I said, they want to verify the sustainability of the labor markets. They talked about a neutral Fed funds rate being historically low, just meaning what we all know, that the rates are low and have been low for a while. She talked about holding their positions during normalization. I don't expect that language to change. She talked about could be going lower or to zero if there's any types of shock. They talked about, this to me also is a reason why they might not be so interested in hiking. They talked about a 2% objective, and she was still saying, even on Friday, that they expect to reach that in the next few years. And they talked about symmetry, which to me means that we've been below the 2% for so long that the Fed would probably tolerate plus 2% inflation for a little bit of time to kind of offset the period that we've been below that. So we're still below that. I don't really understand what they're even talking about with regard to hikes. They talked also about, they paid some lip service to being potentially behind the curve, but we know that they are not. The risk to the outlook balanced to down. So they basically had said that they thought that the economic outlook and the indicators that they look at were balanced, meaning neutral to lower. So it seems to me that they would first have to go to neutral to higher before they would be looking for hike. It just doesn't make sense how that they were so downbeat the last time, and now this time they're ready to go. They also talked about their this to me was one of the most disturbing pieces of what Yellen had to say, that they're still surprised that they're not seeing a larger pickup in wages. So why would they be seeing a larger pickup in wages? The numbers aren't good. We all know that AI and automation are in full gear. I've posted a series of articles with regard to that. I don't see that changing anytime soon. I've said that is here to stay. It is permanent. That is cyclical, not cyclical unemployment. That is structural unemployment. Protests are going outside in front of fast food restaurants that they want their minimum wages to go up to $15 plus, regardless of where you fall on your belief system. The more wages go up, the faster that automation and AI process will exacerbate. The sooner it becomes more economical to put a investment in, to put in robot tellers or servers or what have you. This stuff is real. It is happening. I've gone over some anecdotal stories about my experiences with it, but that is the wave of the future. And I think the Fed, I've heard Yellen before mention a little bit about AI and automation, but they really, I don't know if they just don't want to talk about it or whatever, but it's real, it's serious, and it's happening. I will say this, my interpretation of the Fed has been correct for quite some time. That doesn't mean, though, that the Fed could call an audible for those of you who are into football. They could now say that, we've been on zero for so long that, things aren't necessarily going to get better or whatever, and that they want to hike rates just because. And they could remove their data dependence. This, to me, would be a huge mistake. It would hurt the credibility of the Fed, and they shouldn't be hiking interest rates into a slowing economy. The real purposes of rate manipulation, higher or lower, or to deal with either overheating economies and rampant inflation, which we know we don't have. The type of inflation that we do have is the type that the Fed has really no control over anyway. It's all been in healthcare, mostly in healthcare costs. And they would be basically stymieing the business cycle, which we know is weak. And we have a weak business cycle inside of a structural downturn. So I just don't understand the rationale here for hikes. That, like I said, if they want to go, they are kind of doing it against they're going against the grain. They're swimming against the stream. Whatever analogy you want to give. Anyway, I had talked about this website and that I thought that these numbers had gotten way off sides. Basically, people, in fact, completely discounted the Fed out of the picture. I think the Fed didn't like that, and they wanted to be, they want to keep meetings live. They want to keep sort of the ball in play. And this was a bit larger of a snapback that I think most people had anticipated. I had expected there to be a bit of a snapback, but it wound up being more than I was originally expecting. And I think that was because of just people were so badly positioned off sides that to kind of get back to home, that's what risk managers talk about on big trading desks, getting back to home. It was a Herculean effort. So we now know June is at 28%. I think that this is being suppressed below 50% because people don't believe the Fed is going to move before the Brexit vote. July, however, is up at 61%. That is a little troubling because we all know before this Fed chatter got started, the only hike that had been factored in was December. So now they're talking about maybe 2 to 3 hikes. I would say that the December one, I thought was baked in the cake. I don't necessarily know that we want. I was expecting only one based on the data. The Fed had taken the 4 off the table and had left 2 on the table. And then after some of the data had come in, the Philly Fed numbers were terrible a couple of weeks ago. The jobs numbers were terrible. The 2 scenario had been factored off, and it was only into 1. And now we're back to like 2 to 3. So July is looking at 61%. September, which had been really low, is now up to 68. November 70, and then December is basically a done deal at 80%. So this is a bit of a problem. The December one wasn't so much of the problem. This is the fact that we may have a summer hike into a growth slowdown is what's kind of spooking the markets. I don't necessarily think that the markets are fully convinced either yet that the rate hikes are necessarily to come, but I will talk about that when I get to the S&P. So that's my take. My take is that the data doesn't warrant a rate hike. The Fed should not be moving, but that doesn't necessarily mean that they will not move. Just as I showed you that the market had got so off sides with the Fed not hiking, maybe it's getting a little ahead of itself with the fact that they think that it is hiking. Going through the data points that Yellen has discussed, based on her own criteria, they have not met the criteria for a rate hike. If they do go and they do decide to do a rate hike, it will be a policy error, and we all know what happened after the December hike. Yellen was forced to come out in February and basically say, I'm sorry, I'll never do it again, and that's what the markets have been rallying on because she basically was a game changer with her comments. They were some of the best and most cogent and realistic outlook that I've seen with her in a while. I'm sorry if I've spent a lot of time on this, but this is really what is important to the market these days because the Fed is really the only game in town. There is no fiscal stimulus coming, and the PE multiple premium that the market is trading at is because the Fed is keeping interest rates this low for that long. Stocks, even with their meager earnings, do deserve a PE multiple premium if interest rates are hugging the lower bounds. If that changes, then the PE multiple premium that is awarded or being given to stocks to chase yield, which always we know in the end ends badly, will end. It's a game of musical chairs. We all know the music is going to stop at some point, but the music can play quite long. It could go years longer than people are expecting. So that's the story with the Fed. Let me get back to, since we're still on CL, let's talk about one of the ETFs that people like to play with. XLE broke a long-term downtrend. It is above the 200-day moving average for a while. The checkback didn't even quite get there. We had a golden cross here. I don't really pay that much attention to it. 50 over the 200. We're backing off a little bit, still above a 10-day. I think as long as the trend holds and as long as you're above the 200-day, selling out of the money puts on dips with this sucker is the way to play it. or playing by the dips, as long as you hold these important key trend, the trend, and these key moving averages, meaning the 50 and the 200. The 200 here being the most important. One of my proxies for oil, and one of the things that was a bit of a tell for me, when oil hit 49, Exxon didn't really back off that much. This is making 52-week highs. It is into a little bit of resistance. Of course, we know it is getting a bit overbought. I would be a BTD type of guy, meaning buy the dips if there was anything down to this sort of lower trend that coincided with the 50-day moving average for a right or right out trade. I do believe that oil and the prospects for higher oil are better as long as Exxon is over 83. Even more strongly that it's over 86, which we are comfortably over. So until you really see Exxon giving up the ghost, you could probably assume that oil is going higher. That's just been what's worked, and I will think that until it doesn't. China has had a bit of a pullback. You can see we had this big move down here. We had the check back, look to where the breakdown basically was here, and then it broke down still some more. We got down to the old reference low, had a look below and fail, rallied back up, looked to this basically close to this gap fill, this area where the other breakdown took place. I was actually thinking it could push maybe a smidge higher. It did not. It came back down. It stopped ahead of the 61.8, which I guess is a little more healthy than not, and it is trying to bounce a little bit. However, we are only first coming to the backside of the 50-day moving average. That is going to be a key area, and to see if we can break out of trend. I would be a buyer. I was actually looking for a bit of a push below the 61.8 to kind of sell some out of the money puts, like in more in the 29 area. But it is rallied back up, which I guess takes still a little more pressure off the Fed. If China is rallying, that is good for the Fed and their interest rate hike scenario. One of the ones a lot of people like to play in China, I have stayed away from this I've dabbled in it here and there. I've made some money, I've lost some money. I just find that there's better and easier ways to make money in the market, is BABA. I wanted to show you have a touch here. You have all of this volume in here, all of this in here. This was a potential bull pennant breakout. It wound up being a breakdown, and now you're basically back up into this area. Look at the thickness of this volume distribution here. It just seems to me like a lot of people are getting their money back. You had this breakdown here. This turned out to be a bit of a look below and fail, which was surprising to me. Usually when you have a rally up here like this, which sucked in a lot of longs, and then the next day take it all back in this entire range, and then only 2 days later you're basically back up to these highs. It's confusing price action, to say the least. This stock doesn't like to always respect technicals. It tends to have a bit of mind of its own. I am just not a fan. I sort of stay away. I'll tell you this, though. If you can get back above these highs, these 81, clear 81s into 82s, there could be a little bit more to go into like 85s. But it's just not a clean trader. It's not a clean pattern. My advice is to look for greener pastures to trade in, because by all accounts and measures, look at this. This was a day one of a breakout, and then the next day was a breakdown. Now you're back up to here. So I would assume, based on this quick rebound, there were interested buyers, and I guess it can be construed as a BTD stock. I think you really need to hold this like 77 level down to 76s here. Anything below there to me gets iffy. I would now use this kind of bounce pullback low as a stop if you're long. So you don't want anything to get below this like 76.80. Anything below there to me is GTFO if you happen to be long. I have no position on in this stock, and I will not for a while. I really have no interest in it. IBB, this is a interesting one here, in the sense that we basically got down to here, and we are now kind of by the skin of our chins holding trend, starting to maybe look a little head and shoulders-ish. I don't know that we're going to do that, but I'll say this. There are some key levels to hold in IBB, and we are kind of just getting back above. This was looking like it was trying to rally, broke down. I've talked about the risk being a 1.618 fib extension at 100% retracement of the entire run to complete the pattern down to the lower 200s. It doesn't necessarily have to happen, but for that to be negated, you need price to hold over the 275.40 to 271.77. These levels, I don't want to get too into it, but they are very key areas. Look where this breakout is in this bit here, 271.77. So as long as that area holds, I guess you can continue the rally. Anything back below, to me, gets more bearish. Gilead, I talked about this one being a long setup. We had a bit of a look below and fail here. You can see you had a reference low, some reference lows here, and you had a test, a kind of a meek bounce, a look below, failed, went higher. The rally here hasn't been all of that super impressive, but look where you came from. You peaked at 103 and then got down to 81, back near reference lows. So anyone who was pushing shorts here were getting, it was already kind of getting a little out of a little extended. We'll see what happens here. This could actually be potentially a inverse head and shoulders. You could say that you have a bit of a left shoulder here. This could be construed as the head, and maybe you build out a bit of a right shoulder here. Regardless, you would need to take out this high. You had this move up, a few down, and then you could potentially have a move higher. It wouldn't surprise me to see the 50% fib, which kind of gets you close to the gap near the 50 MA. I don't necessarily know that we get a full gap fill, but it seems like this could go a bit higher. You have some key reference areas here. If you start getting back below 84, which were these lows here, and 83 to 86, this here was 84.04. If you start taking out, too much more of this candle, more than half, we're kind of right about there, it starts getting a little bit more dicey. So I'll say, if you want to keep it simple, stupid, just if you want to be long against the 10-day moving average, anything below there is GTFO and maybe even a RORO short, meaning right or out. Get the F out. I think we all know what that means. There's some confusion with what I mean by RORO. It just means right or right out, meaning you're right in the trade or you get out. That could be for longs or shorts. All right, so let's talk about the broad market via in SPY terms. How's that? So, all right, let's just cut to the chase here. Let's cut to the quick. There were a ton of technicians talking about a head and shoulders pattern and a breakdown that has now been negated and failed. That's just a fact. Once you get above a right shoulder in a head and shoulders pattern, the pattern is negated. All right, that doesn't mean that there can't be downside in the market. I'm going to talk briefly in a minute about a narrow window that's approaching that we could have a bit of a decline into. But let me talk about why I saw this kind of head and shoulders pattern and didn't believe it. A lot of people were, I took a lot of heat on the stream for this, and I want to just tell you what I saw that maybe other people didn't. Context is really important. Internals are really important. And head and shoulders patterns aren't always a guarantee that they will trigger. These pullbacks in here, I talked about the market, bears trying to sell the market off on basically flat or even positive breadth in many instances. And there was only in this whole pattern like one day that was really negative, kind of trend day breadth, and it wasn't even a trend day. So I had talked about the fact that we rallied back up here, that 210, 211 would be some resistance. And then I wanted to see that I said I thought we'd have a pullback, which we did, but I wanted to see if it was going to be a steep and sharp pullback or if it was just going to be one of these begrudging pullbacks that was kind of shallow, and it really did wind up being more of the shallow type. I said that I thought that this was more of a channel, which it was, and not the head and shoulders pattern. And this was evident to me. This is when the realization, I guess, that people thought the Fed was getting hawkish. There was a lot of comments on the stream, and you could see we snapped this sort of rising neckline. First of all, head and shoulders patterns usually are best when they're clean. In this instance, it was a bit mucky because the right shoulder was above the left shoulder. For a more textbook head and shoulders pattern, you want to see a lower right shoulder than the left. Like if this kind of peaked out around here and then had the breakdown, I'd be more on board for the head and shoulders. You also had a bit of a bounce here. You can't really, I guess you can say it's a leg. It's only one day, but the high of this kind of right shoulder was above the high in this pattern. You can see when you had this pattern coming down, no high had eclipsed the prior high, and that's when you get the kind of smackdown. This high did eclipse this high, so the pattern was even more mucky. To convolute it even more, you had a rising neckline. Those are the hardest ones to snap. Usually when they're completely horizontal, it's a cleaner pattern. You had a look below and fail here. I've told you guys time and time again, 204.12 closes below 204.12 is when we get the trouble. I'm going to show you what I mean. Look here. You had the close below 204.12. We get the gap down, attempted rally, but we came down hard. Even before that one was this one again here. You had the close below, and then we had the kind of what led to the flash crash. Same thing like I just illustrated here. This was a look below, and it closed 204.20. You had a gap which trapped all the shorts. You had a ton of people here playing for shorting and shorting and shorting because they knew the head and shoulders pattern was going to happen. What they failed to do was look at the weather forecast. I gave the example of this. We all know that there are different degrees of rain. People saying that the market is in a bit of decline here was saying it's raining, but the people who were playing for the head and shoulders breakdown were assuming it was a hurricane. You didn't have 5-1 and 8-1 and 10-1 and everything negative breath. You had days where Amazon was making new highs. You had days with Facebook was strong. When you have amphalotic selling, and I'm talking institutional, the OTF, the big gun pension funds liquidating, you don't have stocks that are rallying. They're all basically down. It's all like trend days down, negative internals, terrible breadth, and non really responding to technicals. Here, this was more of, like I said in the last video, a summer shower. It wasn't a hurricane, a level 5 hurricane. It was just a gradual pullback. The market had gotten overbought. Look at this. Rallied up, got back into some reference resistance, and was just pulling back a bit. It's expected. You didn't violate levels. These 204s were rock solid support. They had a look below. The look below failed, and it wound up being a rally. So you had the gap and hold. The next day was a hold, and then it was a gap and go. And now you're above the potential right shoulder. We'll just, these were poor highs I talked about in the profile that had needed repair. People don't seem to understand what that means, that there is usually an initial back off and then a repair. They are clearly now repaired. All right, so where are we in terms of SPY now? One, we have broken the primary downtrend. We did it once here. We kind of looked above here and failed. We had a higher low. We had all of this consolidation now to work off the overbought conditions in the market. A look below and fail, a break of the channel, and now another break of the trend that held and continued. I'm still thinking that as long as we are above these highs, this old failed now right shoulder, 208.54, 208.5, all-time highs are likely in play. It would not surprise me to see that. I did talk about a narrow window to sell off, so let's talk about what that could mean. We know we have a lot of concern about the Fed. We know we have, a gauntlet to run with economic data. There could be, a hot jobs number that gets everyone nervous. Let's just talk about option expirations. You have a first quarter expiration in March, and then a second quarter expiration in June. There is a narrow window where there could be a pullback before the window dressing into June. A lot of funds have been underweight stocks or have been playing short and need to kind of play some catch up. So there could be some pullback ahead of then, and then the kind of rally into the quarter end. The other scenario, and I will not discount this for a second, I've seen this happen also, is that we just rally straight into that, and then right after the quarter, there's more of a summer sell-off then. I don't know which one of those two scenarios will play out, but I'm quite confident one of them will. So we're going to have to be on guard for that. The structure here, obviously P profiles of short covering, very poor, but keep in mind what the context of that was. It was people trying to anticipate a top, anticipate a head and shoulders breakdown, and just piling in more and more and more and more short, and now they're all wrong. That's it. So that this was, short covering, and then, they can't get the market down. They even this day was just a consolidation day, and then Friday basically closed almost near the highs. So there are two levels here to keep in mind. One are these two highs here, which were also poor highs. They were 209.81 and 209.76. Anything above that area keeps these highs and the all-time highs in play. If there is a pullback, I'm fine with it as long as it kind of holds this level here, this breakout level of the 207.97. If we start getting back below that area, it starts getting a little bit more iffy, and you might get a bit of a gap fill into this area. That to me would, I know everyone's going to pile on and say it's, terribly bearish. It just would mean to me that, this maybe got a little ahead of itself, and, it needs a little bit more time to correct, that we're not ready to break out of here, that, we might need the Fed to do it. The Fed might need to say we're not hiking. We might need to get through the press conference, and for Yellen to be a bit dovish. I think if she is dovish, I think we're off to the races, and it could be the market could sail off into the wild blue yonder. If they hike and they're more bearish, maybe we get one of these. Again, there could be a large summer sell-off. I go by the levels. I've talked about, never leaving your wingman. My levels are my wingman. We are above the 208.97, which is the reference level for the vestibule into the upper distribution. Moves above here have been brief and unsustainable. For the bulls to really rally, they need to stay above this level. I would say between 207.97 and 208.97. So that's your kind of point buffer. Anything back below there to me gets more iffy, and it would be maybe a sign that the rally, we are really just in a trading range. We got up to the top of it, and it's time to come back down. I don't necessarily think that that's the case this time. This type kind of might be different because we do have a trend line snap here, and we've been up here a lot of times already. Let me go back to the old all-time high. We spent a ton of time up here before. We're back up here again, and now again. So we've banged on this level, 1, 2, 3, 4, 5. This is for the sixth time, maybe 6 times a charm. We might, finally kind of get through. So we'll see how that goes, and keep in mind we are from a higher low. We didn't have the breakdown this time. Maybe prices are ready, truly ready to finally accept a move higher. Again, just go by the levels. If we stay above 208.97 to 207.97, the play is long. You want to be bullish. If you get back below there, you can, either be more neutral to flat or try right or right out short. But the play right now, as long as we hold above that level that I said, I will consider it still a long. IWM, also a little bit of confirmation here. Look at this box. This was the big consolidation box. I talked about this being important. Look at these levels here. We had to look into the area, back off and fail, and now we are popping back into that range. The low of that range is 114.29. Let's keep it simple, stupid. As long as we can stay into that range, we can say that the IWM is bullish. I mean, we could give it a little bit of slippage, right? We could use this low. But as long as the IWM can stay into this box and accept prices in the upper, echelon of the range, you can say it can still be construed as bullish. Anything back below that area, if we start losing the 112.62-ish area, we start losing these 3 days, I'll start getting a little bit less constructive on IWM. The Qs was also a bit of a tell. I talked about us still being inside this box. The 104 to 105 level has been a really key area for a while. It's a big volume distribution. We are now above the downtrend firmly. We had a few days up here. It failed. We're now back up again. We're back up into this really upper distribution above 209.39. Look where these lows were. We had the bit of a look into and fail. Now we're back up there. I'll keep that level as key. Anything above the 209.39 still remains to me bullish. And I would start getting more bearish if we now, broke the, back into below the kind of This shouldn't really be red. It really should be considered a regression line. So let's officially change that here. If we start getting back below the regression line, I would start getting a little bit more bearish. You can see the 50-day has caught up to there. I'll just keep it simple. Anything above the 50 MA to me still remains bullish. Anything below gets a little bit more bearish. So this range, the 109.38 to the 50 MA, still bullish. Below gets a little more bearish. Keep it simple, stupid. Why has that happened? Apple. Apple is a huge percentage of the Qs. I know this chart is mucky. I use it. Just follow where my pointer is, and you won't be confused. We had a big move up here. This was the Nikkei downgrade. Apple slipped here, slipped again, consolidated, and then had a false breakdown. A lot of people were pressing the 92 level. These are, again, very weak technicians who don't take into context, price movement. We had already come from 112 down. They were pressing on lows after multiple days of down move, bombed out stochastics. So I talked about there are two ways to trade Apple. One, a move down to the big 61.8 here, which is around 85.72 to trend line, which was in the 80, at the time it was in the 84s. Or, and this was a big thing, and this is also being dynamic as a trader, anything above the false breakdown level, which was 92.78. I tweeted this out. It's out in the stream. Anything above that level is a long. And I talked about it going back to two key levels, 100.72. Where did we stop to the tick? 100.73. We are not backing off, though, all too hard. There was some selling. It wound up being bought. Apple loves to fill earnings gaps. Look where the 61.8 here is. Look at the level it is. 0.6. A big breakout level in the past with Apple, and if we go back, was 103.72. I want to show you that in real time. Look here. This was the high here. You had the consolidation, the back down, and then this breakout was really what got this context going. We had kind of holds here. This area was a big point of contention back in this area. Again here. And it should be resistance if we get a move up to it. I now believe, and I've talked about, being long down here and selling puts and being long stock and all that. 172 and 103-ish. The 103s are where you want to start booking those profits. So we could have a little bit more help in Apple. If Apple gets rally here, it will be good for the market. If we stall here, I think a move back to like the 10-day, that would be your row area if you want to try, playing BTD again, back where this volume distribution is around the 96s and 97s. Often, there's a look into the gap that fails and you get a move back down into these regions. I think the 95s and 96s will be that area, kind of somewhere contained within this gap low. And that would be an area to maybe play by the dip. If you want to get even more mathematically inclined to it. We don't know where this rally is necessarily going to stop, but you can throw a Fibonacci into there and assume that a 50 or 61.8 would be the area to do it. Right now, that would currently be around the 95s to 93s. I like 95s as an area to sell out of the money puts. Just based on my own tape watching, I think 95s will be the area that you would probably want to start, selling some puts into, and that area should probably support. So that is Apple. Facebook. A lot of people, a lot of late to the party chasers. We're talking about this being a breakdown, and it's not going anywhere. If you buy it the next day, of course, you need the stock to go higher, right? That's not necessarily true. I've talked about these boxes. There's a lot of time where there's consolidation, and then there's a bit of a breakdown. Same thing here. You get the gap up, a lot of consolidation. Some look belows that are buyable. Eventually, there have been moves down to where either the 200 MA, which has been sort of rock solid support. You can see even the flash crash day close, couldn't even close below the 200 MA. Here, again, a look to trend. The bodies all were above the 200 MA. Looky here, trend and the 200 MA are really, really close. Any type of flash move down to that area is a right or right out buy. I don't necessarily even know if we're going to get it. It could just keep going for a while. Look where earnings would be. You'd be close to the gap fill and trend. So maybe it does one of those where it just kind of chops around and gets there. This, listen, also can resolve higher. There's nothing that says that the Facebook can't go higher. The only thing I've talked about as being a problem is this progression line. Any moves above there have not been sustainable. Look at this. All of these moves above here have met with consolidation and selling. Again, above consolidation, selling. This one wasn't even that much consolidation. Again, up here, we got close to it. In one of my charts I've talked about before, it was actually slightly above, but it's led with some consolidation and selling. The Facebook pattern, if you want to do a 1.618 fib extension of the range, would take you up to the 130s. I do think that is in the cards. I just don't know that we don't get the gap fill first and then the move there. We could also just get consolidation and a move higher. I have talked about playing this with strangles. Now that we're more multiple days into this, I'd start looking to peter out that strategy as the risk of a potential quick kind of come down is increasing. I do like Facebook still longer term. My story with that is that they are taking market share from the likes of Google. First, the move was from print to online, and now it's from online to mobile and social. And we know that Facebook has been the king of monetization of that space. I still like Facebook. On dips. Someone was asking me about selling out of the money puts. That's actually where this came through. I think this is like a single-digit IV percentile. You do not want to be selling puts in this. If you're long, you want to be buying puts or put spreads as protection. If you think still higher, buy longer-dated calls or call spreads or what have you. You don't want to be short premium in this. You want to be playing this either just flat-out directionally long or short, be a long premium, meaning long calls or long puts. That is my view on it. Amazon, also a major disruptor. We know the woes of retail. I'll tell you, I had an experience. I was at Best Buy the other day. I was buying a product, and I had to wait. The staff was really rather incompetent, and I said to myself while waiting, I now know why Amazon is $700 a share. You have amazing customer service. You don't have to deal with anyone. You don't have to talk to anyone. You can just go online, shop, get the best price. And, be done with it. And if you want to return, there's no hassle, there's no lines, nothing. These guys have just done amazing jobs. They've, had their web services. Other companies are buying it. Seasonally, this isn't the best time for retail, although Amazon seems to have transcended that notion. Their 1.618 is all the way up here at 833. I think it eventually happens. I just don't know that we don't get a pullback first. I would love to sell out of the money puts or buy right or right out long against this trend line, particularly if there is a 50-day moving average involved and reference lows. In my experience, you get this gap up, a move up, and then there's usually a come down ahead of earnings that kind of like tests everyone's gumption into the original gap range. I don't know that Amazon isn't going to just chop and then go higher. It is definitely doing a great job consolidating. I think longer term bullish, but it's a harder chase here. If you do happen to get above the 722.45, that is a technical right or right out long trade for a move higher. I think the path of least resistance, as long as Amazon is above 696.44 to 684.82, this range, I think that it still has a potential for going higher. I would, a lot of people are trying to say, oh, it got too high, it's a short. Not necessarily true. I like to trade along the line of least resistance. The line of least resistance, yes, of course, you can get pullbacks in Amazon. If you were short this day, you probably made some money or whatever. I like to trade along the trend and the path of least resistance. Amazon is an up stock, meaning I want to buy the dips. I'm not looking to short the rips. If the pattern alters and it starts becoming something like this, then I'd be more of a short the rip type of player. I did talk about that as being a strategy in this, and now I'm saying that, the stock is proving to be stronger. You want to be more of a long player. Netflix, same business. It has been in a bit of a come down phase. I talked about this look being multiple points again, coming down into some reference areas. I said that at some point we would retest the 50 MA. Wow, that happened really rather quickly, and now it is getting back to the down channel. I would be a little cautious first chasing here. We know that 103.88 to 105 has been some very key resistance areas. You might get a downtrend break just to fill the gap, but I would be more looking to book profits now as opposed to chasing the long. I think that it could go higher, but the kind of easy money, so to speak, there's really no easy money on Wall Street, but when you're DAC into reference lows, once you broke this kind of sideways consolidation, that was the long trade. But, we are getting into a downtrend and 200-day moving average, some very visual reference past resistance. I'm sorry, past support, which is now resistance. I would be looking to kind of trim those longs into rallies further into Netflix, at least for a pullback. Longer term, I would say that the stock is, still showing that it's there's a lot of relevance. There's some comps of other companies that might be, coming public or valuing themselves. I think that, the overall enterprise value of Netflix of whatever $40 billion or whatever it is probably undervalued. Bigger picture. Short term, though, it's an expensive stock that, trades an outrageous PE multiple. I like the idea of booking profits here into it. Still could go higher, but I'm not a chaser. The Google, I've talked about how I like to play this. I like to be a short at the channel high and a long at the channel low. In between is sort of a little iffy to me. 752.05, that was the gap here where we had the selling, and any move on the upside of that has usually been a move higher. I think that this was support here. It now should be a little bit of resistance now that we're coming back up into the gap. Google likes to fill earnings gaps. I do think that gap will fill. I also think that there will be an amazing opportunity to sell some out of the money, short-term out of the money calls or write out shorts up there, particularly if it coincides with this sort of downtrend. I don't like to play in the middle here. I just think it's very choppy, but I do think that Google could have a little bit of higher before maybe a move a little lower. That Google also historically in the summer tends to have some issues with their earnings. Usually the move tends to be lower, so we'll have to see if that seasonally plays out. Tesla, let's keep it simple, stupid. I talked about this. Being a sale at 265, it went a little bit higher. It pulled back to the 50% fib. I said I had my fingers crossed for a move back down to the 91s, to the 61.8. That wound up not being the case. It wound up coming up higher. That's okay. We had another opportunity. They did a secondary. I think they priced it at 215. I could tell, and I tweeted about this, that when they came out with the this was shady business, first of all. Goldman Sachs upgraded them the day before or the morning of the secondary, and then after the bell, they came out with the secondary. So this was a whole shady mishigas to begin with. Anyway, I talked about there being a move down in the after hours, and then the stock was basically trading flat. It was like 203 or something. And I said that the shorts really better pray that this stock isn't up tomorrow, or else they're going to get their faces ripped off. They wound up pricing the secondary at 215 or whatever, and then the stock wound up rallying because, this was still heavily shorted. Again, it had come down very far, and they wound up, when there's bad news and a stock doesn't go down and it goes up, it tends to, frustrate a lot of shorts, and it wound up going higher. I'll tell you this. Let's keep it really simple. 215 was the point, right, of the secondary. Anything above 215, the path of least resistance is higher. Anything below there, you might want to play GTFO or just not be involved. Or you could try write out short against that 215. I would probably just be more neutral. I don't usually like shorting Tesla all that much, just because the story of Tesla, like I said, really has very little to do with what they actually do. It's sort of an exercise in the mechanics of the stock market, it being a poorly distributed stock with high consolidated insider ownership and a high short interest. Those usually tend to be squeeze opportunities. 200 MA has been very key. You can see it with some resistance here. As long as we're above the 200, you want to be long. Above the 215, you want to be long. Below, you want to be more flat to neutral, or if you're so inclined, right out short. Seasonally, this is a very good time for Tesla. They usually do well in the summer months. It tends to peter out toward the end of the summer around the horse show, but we are at the beginning of summer. This is when all the summer Hampton share houses start. This is the beginning of the summer, basically, a Memorial Day weekend. So Tesla has, the seasons on its side. Someone had asked me to talk about Visa. Not one I cover all that often. I actually need to do some updates to my charts and my levels here. But let's just talk about the Visa. They are benefiting tremendously from American Express's woes. Costco, as we know, has switched over to Visa. I don't necessarily know if this is going to be their huge breakout quarter from that, but I do know that they are sort of have the wind at their backs. I like the idea that we are above this. I don't know why I have it as it was a downtrend. As I said, I haven't updated this chart in a while. It's now a bit of a regression line. You can see the downtrend has supported. We came up hard. These last few days have just been consolidation and a move up higher. This should probably fill the gap. I would think Visa could easily, if it wants, make new all-time highs. Let's just use the 50 MA. That's been the support here as the gauge. You're a little bit far away from it, but I like long against the 50 and then flat or short below it. The 200 is also played a key role. So if it does wind up being a little weak, you could play put ratios like long these and then like short 2 times the amount near the 200 or near one of these Fibonacci levels. I would likely be a buyer considering we made a new high if this wound up being like kind of a failure coming down to the 61.8 or even the 78.6. This consolidation here is very key. We had a gap down earnings bar. If you're really near-term time frame, 77.28 was the low. You don't want to be long below there, and you have a high of 79.36. I think you can be long above that area, so let's just use this earnings or even this bar here, which was even more recent, this range. They look very similar. So let's just use this one since it was the last one. Keep it real simple. 77.66 and 79.5. Below there is, out. You don't want to be long. Above there, you could still be long. Very simple. I think we can end there. We're over an hour. That's quite some time. I had a few more I was hoping to cover, but hey, we'll have something to do with Periscope. Oh, and hey, by Periscope, by the way, wow, 19,000 followers plus, almost 20,000. Thank you guys so much. It's really a pleasure to do these videos. I'm glad that people are finding value in them and following and listening. If you're not following me, follow me on Twitter. My handle is @JustinPulitzer. Please hit the thumbs up button if you like this video. If you have any comments or want any clarification, just leave a comment or tweet me. Anyhow, that's my story. I'm sticking to it, and I will see you. I'll probably do Periscope. My guess is Wednesday or Thursday. I might wait till Friday since it's an abbreviated week and we have that big jobs number on Friday. There could be some big market reaction to there, so I might do it sometime between Wednesday and Friday. Let's keep it simple. More likely Thursday or Friday. Anyhow, that's my story. I'm sticking to it. Cheers.